FICO's untouchable moat makes shareholders sleep easy, but for many investors, the valuation is too high. I recently covered FICO's 43% drop and gave my valuation on the stock. Since then, several crucial details have come to light. In this video, we will cover how I've now added FICO to the portfolio, the two major factors that I missed when doing my initial analysis, and how Charlie's wisdom influenced my purchase. Let's get into it. So, I was wrong about FICO. Originally, I priced in my valuation that I'd be buying at $1,200, but since then, my opinion has changed and I actually bought into FICO at an average price of $1,383. Here you can see where I bought, either side of this little peak. It's a £1,400 position, currently up 2.6% off the back of the Fed news where Jay Powell has hinted that he might cut rates, and the hints at the rate cut actually improve my thesis about FICO. So for me, it's a £1,407 position, and this actually is a very small part of my portfolio, about 2.83%. Here's the rest of my portfolio for reference. If you want to have a look at it, it's about £50,000 with a total return of about 13,500, a rate of return of 105.6% currently. So pause the video if you want to have a look at the portfolio. The portfolio is currently outperforming the S&P 500 by 14.67% over a period of about 3 years. But let's just remember, guys, that beating the market is all about the long term. Everyone's a winner in a bull run, so we'll have to see how time treats the portfolio. Hopefully I continue winning like I am at the minute and outperforming. So in my previous video about FICO, I explained the strength of FICO's moat, and I highly recommend, if you haven't seen that video about FICO's moat, you really should see it because you will understand the company far better than anyone else you know. I had some really nice comments. Thank you to everyone who commented. So what did I do wrong? Well, in my previous valuation, I didn't include a few things. This was my previous valuation, and I made the assumptions of no price increases until Q1 2027. Price increases of 13.25% annually from 2027 to 2030, and a scores volume increase of 3% annually from 2027 to 2030. So this is all quite conservative stuff, really. And the Vantage score takes a 10% market share. I cover this very much in my last episode, how Vantage score, how much of a percentage they will be taking from FICO if they actually perform. And the software business is 3% CAGR per year. There's some new things that have come to light that affect these assumptions drastically. So the first change that I'm making to these assumptions is FICO has actually stated that its pricing strategy is unchanged. So FICO stated that its mortgage scoring pricing strategy remains unchanged following the FHFA's decision to implement lender choice for conforming mortgages. Management indicated there remains a significant price to value gap with its mortgage scores. As a proxy for how much a FICO score provides, the company cited that the rating agencies charge 8 basis points on average to rate corporate debt. Applying that same spread to the average US mortgage of $375,000 results in an implied value of $300 per score for protecting mortgage industry participants from credit and prepayment risk. Currently, FICO charges only $4.95 per score, and mortgage costs make up $6,000. So there is a very small amount that FICO makes up in terms of the score payments per mortgage. FICO indicated that pricing increases for the next year will be similar to recent years, but have not yet been finalized. Management stated that beyond mortgages, it is continuing to execute on its pricing strategy for auto scores. So it's also going to increase auto scores. Obviously, the FHFA announcement about lender choice for conforming mortgages does not affect auto scores at all, and they're just going to continue to execute the pricing strategy on the auto scores. FICO noted that most recently the auto score prices have increased in roughly low double digits, but I think there will be an acceleration in that. When they reference the fact that pricing increases next year will be similar to recent years, then you have to remember what their recent years look like. In November, FICO increased its price by more than 40% for a mortgage origination. So it's huge price increases. Now these are quite steady estimates done by somebody on Seeking Alpha, and they show a 20% CAGR from $4.95 to $6, 7.1, 8.2, and $10.5 by 2030. And you can see the CAGR. You can see the percentage growth rate per year on that. And like I mentioned a second ago, the FICO score still makes up only 0.2% of the mortgage closing costs. So there's plenty of room to continue growing the price increases. My new presumption is that there is going to be continued price increases, $4.95 to $10.50 by full year 2030. So this is a CAGR, an average CAGR of 16.2%. On to my second change. This has to do with mortgage applications. Now here you can see the mortgage application composite index versus the 30-year fixed mortgage rate. And the blue here is the volume, basically the volume of mortgage applications. You can see it's drastically fallen about around 2023, 24 into 2025. And you can see obviously rates spiked and the volume fell, which is to be expected. But this is where we sit at the minute, a composite index of 250, and the average is actually 460. So we're way off of the average volume of mortgage applications. For every mortgage application, FICO will earn more money because there will need to be a FICO score in place for that mortgage application. And the hints from the Fed that rates will drop could drastically increase mortgage application volume. This means a higher volume of growth for FICO. So my new presumptions are based off of this composite index. 250 to 460 over 5.5 years gives a CAGR of 12.5% volume growth in mortgage applications. So before I only said 3%, and it looks more likely to just get back to average as a 12.5% growth rate. So here are some other sources that cite how mortgage applications and originations have lowered. In 2023, approximately 10 million applications were made. In contrast, 2022, 14.3 million applications were made. This was a decrease of about 4.3 million or 30%. And then you can see in 2022, 14.3 million applications were made. And in contrast, in 2021, 23.3 million applications were made. That's an application decrease of about 9 million or around 38%. This data is from the Consumer Financial Protection Bureau, and they only released their data about a year late. So the data for 2024 will come out in probably December or this September 2025. So I'm waiting to see what that is, but it should just reflect what we see here from the Mortgage Bankers Association. So with these updated assumptions, I've used my EPS growth calculator specifically for FICO, which takes into account my specific assumptions. It's given me a 1.7 billion full year 2030 net income, and the assumptions are continued price increases of 16.2% annually from 2025 to 2030, a scores volume increase of 6% annually from 2025 to 2030. So I still believe I'm being quite conservative here. A scores volume increase of 6% is half of the value that I calculated earlier if we were to just return back to the normal amount of mortgage applications. So we'll take that into account, that's quite conservative. VantageScore takes the 10% market share. Software business grows at 3%. These two are the same assumptions. But here on my EPS growth calculator, specifically for FICO, we can see I've put the scores price CAGR in there, scores volume CAGR, software CAGR, buyback estimate of 3%. From my previous video, I showed how scores earnings were 80% of the overall net income and software earnings was only 20%. So using all this, we can calculate using the exit PE multiple method that if we were to stay at a 53.7 PE, which is the current PE ratio, we would achieve from here a 23.54% CAGR, very much outperforming the S&P 500, more than doubling where I bought in, which is 1,383. If the multiple was to lower, which is definitely a possibility, we're looking at if the multiple was to go to 45, 19.62% CAGR. If the multiple was to go to 40, a 17% CAGR. And if the multiple was to go down to 35, just less than a 15% CAGR, looking at more closer to a 14% CAGR. Now, I personally am very happy with those returns, and that's why I entered a position, albeit a small position. I'd love for it to drop a little bit more. I'm seeing a lot of people saying that they are going to add around that $1,200 range. So I really just don't think that it will, if it does get there, it won't stay there long. Investors will just snap up the opportunity to get this high moat, high quality stock in their portfolio. Now, if you're wondering, this is the current price, $1,420 per share. And these are the returns based on these assumptions that you get from that. So only just less than a 14% return, 13.73% return at a 35 PE ratio. But I think we're more likely to be sitting at around a 40 PE ratio, which is a 16.53% return from here. So I don't think you're too late if you were to buy into the stock now. However, this is not financial advice. Don't take random advice from people on the internet, even if they do have some nice EPS growth calculators specifically for FICO. So what convinced me to pull the trigger? It was actually a few Charlie Munger quotes. And Charlie Munger was famous for saying a great business at a fair price is superior to a fair business at a great price. Another thing that also influenced my purchase is he said the risk of paying too high a price for good quality stocks, while a real one, is not the chief hazard confronting the average buyer of securities. So essentially he's just saying if you're buying a quality stock, you're unlikely to see massive downside. And this final one really made me pull the trigger, saying generally speaking, I think if you're sure enough about a business being wonderful, it's more important to be certain about the business being a wonderful business than it is to be certain that the price is not 10% too high or 5% too high or something of the sort. Now, this is exactly what I was basically doing in my last video, where I said that I want to buy in at $1,200, which essentially was like 5% too high, between 5 and 10% too high. And I think this quote really made me reconsider. And also, obviously, the new factors that have come to light made me reconsider. But this was something that I just thought, I want this quality company in my portfolio and I'm going to add it. But to buy into this high quality portfolio, I did actually trim a stock. Now, which stock was this? I trimmed HIMS stock. So I sold £500 of HIMS and £530 of HIMS at two different points at very different prices. I sold this 530 at $70 and I sold this 500 here at $45. So in total, I sold £1,030 worth of HIMS at an average price of $57.63 if you were to average these two out, and my gain from that was $332. So that is essentially a 40% gain there, which is great to see. So that is essentially a 40% gain that I have made in That is essentially a 40% gain I've cashed out on within 3 months. Only bought the stock about 3 to 4 months ago. And if you're wondering about my Hims & Hers position, it is still a large position, £5,644 worth. There's my price that I sold at, so it's actually a very good price over the last 3 months to be selling at. Yeah, it's still £864 in the green, 18%. There is a few things that I want to talk about with Hims that I will get into in the near future, and obviously I bought £500 worth of FICO with that. The rest of it I invested new money to buy the rest of my position in FICO, and then £530 went into Alphabet or Google. That's just a brief update on my portfolio, guys. I hope you enjoyed the video, and I'll see you in the next one.
I'm hopping out Ferrari, my house is 3 stories. I'm still independent cause Jive couldn't afford me. The meetings were boring, for real I was snoring. The VP was fine, yeah she did